think markets are missing is the opportunity in both stressed and distressed credit, especially in Europe. And I realize that may sound a bit crazy considering the rally we've had in risk assets this year. And admittedly, the opportunity isn't obvious if the market is just looking at credit indices. Spreads in the US are fairly tight. Triple C paper, the lowest credit quality and high yield, is the best performing area of credit in the market year to date. Not really showing any signs of distress. In Europe, spreads are a bit wider. Triple Cs haven't seen the same strength as in the US, but overall, nothing's really outside of historic norms. But I'd argue the indices aren't telling the whole story. And in my opinion, again, they don't reflect the distressed opportunity in Europe that is here today and forthcoming in the US. Just maybe a quick moment on how we got here. Over the last few years, as everyone knows, central banks have cut rates to zero. Some even went negative. They flooded the world with liquidity. Anytime there appeared to be any stress in the system, the reaction function of central banks was to pump liquidity into the system. During the pandemic, that really went into overdrive. And as you would expect, corporates gorged themselves on really cheap funding during this period. And, frankly, they were rewarded for it. This was a period where the market valued growth over profitability, and levering up balance sheets was a really quick and easy path to growth. Many believe that this was just going to be the new normal. There's huge swaths of market participants that have never seen a real hiking cycle. And I'd argue the market got complacent and believing that rates would stay low forever and liquidity would be ample. And then all of a sudden inflation showed up and ruined the party for everyone.